It's interesting, and I was going to ask you that very question. Why do you think bonds would rally in the face of a Fed which you yourself admit has gotten its mojo back, or at least appears to have that, yet you see the 10-year yield going below 2.25%, 25 basis points, or if not more, lower than where it is today, before starting to rise again?
Well, it has to do a lot with sentiment and positioning, why I think the market's going to rally. I mean, there's a massive short position against the Treasury market, pretty much along the yield curve, 5-year, 10-year, the whole bond market has a huge short position. And it's tough for a market to really go in a trending direction when there's such a crowded trade underway. And also, you say, why would the market rally with the Fed tightening? Well, what's so bad about the policeman being on the beat? I mean, if the Fed's going to be looking at the inflation rate and looking at the unemployment rate below 5%, supportive of raising rates, it kind of means that the case of them being behind the curve with rising inflation, say, a year from now is much less of a strong case. And so really, when you're buying long bonds, you don't want inflation. And we knew that the bond market was going to sell off. In July, we turned maximum negative on the bond market because we were staring down the barrel of an assured increase in the CPI to a level well above 2%. And we're already above 2% on the headline and the core CPI. And it may very well on the headline number go to 3% or nearly 3% in the next month or two, just because the effect of the oil price having gone from the 20s up into the high 40s and even low 50s recently goes through the CPI data. So we know that the CPI was going to go up, and you can't have the 10-year yielding 1.32 when inflation is up at 3%. I mean, it's almost insane. You need something like a wild QE program like what's going on in Europe,